Hi, it's Tip Tuesday again because it's Tuesday. You know, with this year, starting at the first of the year, we've been talking about New Year's resolutions that would make sense for you. We talked about accountability and how to just kind of make a resolution to be accountable to yourself on your retirement plan. Last time we talked about the evaluate step. Evaluate where you want to be. Make your bucket list. Make sure you know what your retirement is going to cost, roughly. Obviously, you can't know with a crystal ball for certainty, but you can do your best. And then also, consider your budget. What are you spending? What are you making? What is the gaps? What gaps do you need to fill? How much more might you need to save to get to that ideal retirement budget or that ideal retirement savings plan to create that budget? Now, we're going to talk about execute. That's the third of the three E's. We talked about the evaluate last time. We talked about the envision the first time. Now we're going to talk about execute. Executing might be the hardest thing to do because sometimes you don't know how to execute that plan. You know where you are, you know where you want to be. How do you get there? That's probably the time you might need that helper, that advisor, somebody that's a little bit more experienced as you are to help you with that asset allocation, to help you adjust your risk tolerance to the investments that you make and make sure that you're on track. You know, when you climb a mountain, I actually had a guy that, a prospective client that came up that climbed Mount Everest. And, you know, sometimes I relate the idea of retiring kind of like climbing a large mountain like that. And the goal is to get to the top of that mountain. But there's another goal, and that's getting off the top of that mountain back safely. Now, if we consider our working years climbing that mountain, and then the retirement years is getting down that mountain safely, most people who've never scaled that mountain before get a Sherpa, right? They have these Sherpas that climb that mountain every day that show people the way. And as an advisor, I like to be that Sherpa for my clients. If you don't have a Sherpa, feel free to call us. We'll be happy to help guide you in the way to pick the right products and navigate that retirement course in a way that is more tolerable for you, is more focused on your plans and your goals to get you to that top, to get you that retirement date, but even more importantly, to get you down once you're up there. Now, when we talk about a retirement plan, we typically talk about the income plan. Right now, you're probably in the place where you're accumulating assets, where market risk is not quite as important. But then again, as you get closer to that retirement date, market risk is more important. You can make very bad mistakes by getting close to retirement and losing half your money in the stock market, for example. So how do you get around that? Well, pick the right products, pick the right strategies is really the key. And just to name a few, make sure your risk tolerance with your stocks, bonds, and cash accounts are allocated appropriately. Revisit that and rebalance that every year. The other thing is, you get closer to retirement, you might want to consider that future income need and consider taking some of those investments off the table and putting them in things called deferred annuities. Now, an annuity isn't a bad word unless you listen to a Wall Street company that doesn't sell annuities, but annuities are really built for income. I like annuities for income. When you get to retirement, you're going to want income. You're going to want Social Security to be maximized. You're going to want some of your investments to create income. And I don't mean income in this form of a 2% dividend or a 4% possible interest rate on a high yield bond. And unfortunately, 4% is high yield now. Didn't used to be, but it's hard to get interest and dividends that will pay all the income you need. Annuities can be structured where they can pay out a much higher rate of return and a much higher guaranteed rate of return no matter how long you live. And I believe income should be structured that way. So when you've already done the evaluation process, you know where your income needs to be. And if you know your Social Security and your pensions aren't going to make it, consider systematically moving some of those investments out of your 401ks and IRAs into annuities. Now, where do you get the best annuities? The ones that pay you the most, not the company the most, but that pay you the most. There's three people that get paid on annuities and these income type products: the agent that sells it to you, the company that creates it for you, and you, the person who actually puts the money in. Now, I believe you should buy the annuity that pays you the most, regardless of, agent, how much you like your agent or the company you do business with. So again, you might need a Sherpa to help steer you in the right directions to find those right annuities that pay you the most. Now, if you're going to be in a tax problem or a tax situation where you're going to need or possibly be in a higher tax bracket or as high a tax bracket as you are in now in retirement, you might want to consider a tax-free version of retirement accounts called Roths, Roth IRAs. If you want to create a tax-free version of an annuity, you might want to consider LIRP, life insurance retirement plans. The life insurance, permanent life insurance policies actually have tax-free benefits much work much like an annuity, but have tax-free benefits so that you can grow your assets, maybe the amount over and above what you maximize your contributions to your 401ks. If you have extra money and you can't put it in a Roth because your income is too high, you can put it in LIRPs, permanent life insurance plans, and create your own future annuity. And the cool thing about that is that that annuity payment, that annual or monthly, quarterly payment, whatever it is that you take out of that annuity or that life insurance retirement account, is tax-free. And those accounts can grow at rates beyond 6% or better. That's a pretty high rate of return for a guaranteed no-risk cash value type of an account in a tax-free environment. So don't discount insurance companies or insurance products as a great way to create that income plan that you're looking forward to using in retirement. So execution means make sure your assets are allocated properly, not just the stocks, bonds, and cash, that they're allocated properly based on your risk tolerance, but also make sure that you're allocating into those assets that will create permanent, guaranteed lifetime income once you get to retirement. And if you want to go the extra mile and the smart mile, which is keep in mind your tax situation, you might want to consider those tax-free versions of those annuities or lifetime income accounts. That's enough time for the tip of the week today. I hope you execute a great plan. If you need some help, be sure to call your Sherpa. If you don't have a Sherpa, give us a call. We'll be your Sherpa, and we'll help you climb that retirement mountain and get down safely.